Hey there, Pretty Old Pride listeners. Thanks for joining me on this episode. Today I'm solo. I'm going to be chatting about a topic that is pretty important these days. This time when this recording is going on, we're living in some certainly economic uncertainty, and we're at a portion of the economic cycle that we have massive amounts of debt from a government to private debt, you name it, debt. Everyone's got debt. It's like a global phenomena going on. And, debt's really can be a bad four-letter word for some, for sure. And so for today's episode, I just want to share my thoughts on this because, there's good debt and there's bad debt. And you got to figure out how that plays into your life and certainly your financial sort of wealth building and preservation. And if you look, at our government today, you can obviously see that they don't mind having some debt. Right now, if you ever go on the debtclock.org website, it's amazing. It's a continual tallying up of our government's debt. And I think it's in the range of 30 trillion, as we speak, and growing. And so that's kind of at this point, amazing number. You can't even really put your head around it, frankly. It just kind of looks like funny money, but it's continued to grow. And now we're at a point where interest rates are rising. We're getting the Fed sort of increasing rates, and that's sort of reverberating throughout the economy and potentially putting us in a recessionary sort of period. So we've got a lot on going on now as it relates to debt, and even for home buyers where mortgage rates are rising to levels that are historically not bad, but when you're so used to easy money and cheap money, it becomes and feels really, really expensive and painful. And so it's we're in a situation now we have to be mindful of that and understand how it impacts our financial futures. And so in my own personal experience, I've always sort of thought of debt in a negative way, right? I didn't want to have debt. I've seen so many people go into debt and put them into very serious financial straits, and I never wanted to. So growing up, I thought that was bad, right? It was something I shouldn't entertain unless I really had to. And so what did I want to do with pay cash, right? That's the alternative. Save up money. At least you'd save up some money and pay cash. Well, that's not always, in a lot of cases, the best option either, because in reality, in our worlds of what we're trying to do to live our lives, to fund our lifestyle, take care of our families, and invest, we basically finance everything we buy, whether we pay cash right out of pocket or we take on debt. So when we pay cash, we certainly give up the ability to earn from those dollars in the future. And honestly, we're just taking on debt. We are subject to paying interest costs explicitly. So what is the best way of thinking about this? So I think of this in two ways. Obviously, I think everyone would agree, and Dave Ramsey is really a big proponent of this, is that we shouldn't take on debt to consume, right? And I think we get so used to that. I don't know how many trillions of dollars sitting on credit cards today and at extraordinary high interest rates, and it's going to get worse now with interest rates rising. But I think everyone agrees that taking on debt to fund your lifestyle and pay for, things in your life, like, just groceries or normal things or TV that maybe you can't afford today or vacation you couldn't afford to go on. Obviously, that's probably a bad use of debt, and probably is going to hamstring a lot of people financially for a long period of time, especially as interest rates start to rise as the cost of debt increases. So I think everyone sort of would probably agree that taking on debt to fund your lifestyle is not a good idea, but we get so wrapped up in it because it's easy to get, and we want to have a lifestyle that you see on Facebook that everyone has, and we get so wrapped up in those external pressures that we take on debt. And it can be really harmful for people to save and build wealth. And unfortunately, keeps people on this hamster wheel of of indebtedness to financial institutions, banks, wherever. So obviously that's a bad thing. So I think, if you're in that situation, then it's really incumbent to figure out how to reduce those bad debts and get them into a better state. Maybe borrowing from cheaper institutions and reducing rates, or finding ways to pay them off, whether through increased income or use of other assets to pay off those bad debts, or conservatively find some other assets to help pay them down, right, through cash flow, right, positive cash flow. And that's where we get into the other side of it, which is good debt, right? What is good debt? Well, good debt, in my mind, if we take it from the perspective of the teachings of Richard Kiyosaki or Rich Poor Dad, is asset is something that brings you income. And so if you had debt against that asset, it's really, you have debt, but you're not in debt, right? Because you have an asset that is of higher value than what you owe, and that asset is producing income for you that is helping to pay off your debt. And the easiest example of this is a piece of real estate, right? If you have a rental property that you can hopefully have it productive, and you're providing a good service to a tenant, and they're paying you monthly rent to live there, and it's helping to bring you cash flow positive, and certainly pay all debt that you have on that asset, and hopefully that asset appreciates. That's a perfect scenario. Obviously, it doesn't always work that way in real life, but that's an ideal situation. So putting money and getting debt to support an asset that brings cash and positive returns to you is a good use of debt, and doing it wisely. And there's a lot of different ways to do that. So that's why a lot of folks have a significant amount of debt, but they may have assets that can be a productive long-term investment for them. And so there's a lot of ways to go about doing this. Obviously, where most people are getting debt, maybe they're using their income to get debt directly from financial institutions. But one of the ways that a lot of folks who now we've built up a lot of assets, or we have a lot of money tied up in our stock portfolios, or money tied up into your house, or even your personal residence. So those are two ways where you have access to credit, maybe getting lines of credit, collateralizing those assets because you don't want to sell them. You may want to stay invested there or stay in your home. And so you can have a loan against your stocks, and your house also can be used as a home equity line of credit, and use those assets and those dollars to maybe use in other ways and investments on top of it. But the challenge with those two options is that the asset that underlies those debts could actually go down in value, right? We see it today with the stock market going down or having downward pressure. We have houses that obviously have been appreciated in value. They are also potentially coming under pressure to come down in value. So those are potentially dangerous areas to draw money out and take loans from. Definitely can be used, and neither loan could be used as a source of short-term liquidity and reserves. That is something that I think makes a ton of sense, but they do come with some level of risk, and they're also usually tied to varying interest rates, variable interest rates. So as interest rates go up and friends at the Fed continue to keep interest rates rising, those costs are going to go up as well. So definitely some risk areas with that, but definitely a viable option. One of the sources of debt that certainly that I would support to and use personally is debt tied to money being stored in life insurance policies. For people who don't understand life insurance, it's a asset that designed properly can store cash very, very well with no chance of loss. But those contracts offer a guaranteed financing option that you can borrow directly from the life insurance company, and you can some are fixed rates, some are variable rates. But the good part about those is you can control the terms of those financing arms, so you can pay them back whenever you want to, and you have to be disciplined with this. But in some scenarios, you don't ever have to pay them back, and your death benefit would cover off any debt outstanding when you pass away. But for most people, and certainly in life, you want to pay them along the way, but there's flexibility because there's no monthly payment is required. Just like if you have one like a home equity line or margin call, there's going to be interest costs that are going to be required. And the good part about the life insurance is that asset does not go down in value. So you can be at least secure that your collateral is not going to go down in value, and you're going to have to be required to put more money in to ensure the loan is still good. So it gives you some flexibility. And so this is just some of the ways, and usually using those dollars that you get from debt to deploy them into investments like real estate or private lending or whatever it is, syndications. These are ways that you can, ensure that your dollars are returning more than what you borrow, right? So if you have an interest rate of 5%, make sure your investment is going to produce more than that to cover your interest debt. And now you're doing what banks do. They borrow our money and then loan it out to others and make the spread, right? And so those interest rates could be pretty sizable. Even if I borrowed it, say 1%, and I loaned it out for 3%, right? Very simple. It's not a 2% return. It's a 200% return. I took $1 and paid that dollar to create $3. That is really a multiplier effect. And this is the concept that banks use all the time with our dollars. We can also use that sort of same philosophy for our own wealth building, and using sort of vehicles and tools that are more stable and solid, like life insurance. It can be really, really valuable. And this is really for, it does take a different lens around debt. Because some people are scared with it. And so I wouldn't advise for people who that's a worrisome sort of thing that would keep you up at night. Definitely not a good option. But for those who understand strategically, and especially if you know what you're investing in, which is the other arm to this, I wouldn't, if you're speculating, I would not want to borrow funds to invest in it. And that could be a portion of our assets. I think there's always, especially if you have a solid base and foundation of your financial life, going into speculative plays that could really have outsized returns. I think that's just fine, especially if you have really solid foundation elsewhere. Then you can go for some home runs, right? Because you have a lot of singles going on elsewhere, and you have access to liquidity. I wouldn't want to borrow money to invest in those things for sure. But you have solid assets that are pretty reliable, and you've done your diligence to understand and learn about them. They de-risk them. I think this is a viable option, right? Because you can take cheaper money and create cash flow and returns and earn higher rates of return. And the idea of using life insurance in that case, you actually haven't borrowed your money, you're borrowing someone else's money, and all of your assets continue to grow and compound to, uninterrupted. And that's really the heart of the other side of the coin of using cash. Once you use cash, that money stops working in that account. Now, people don't care these days because you put money in a bank, it really doesn't earn anything. So I get that. But if you had a better storage facility for cash, then you may not want to disrupt that because it can earn 4 or 5% and grow tax efficiently and just grow and compound and do its boring sort of work behind the scenes as you're leveraging someone else's money to grow wealth. So just something to consider as you think about your wealth building and how you control it. Act like the bank and leverage other people's money, but put them into investments that you can own and control and have better understanding with, that hopefully de-risk things and could really accelerate your wealth in a very positive way if you're doing it in a very smart way and learning what you're investing in. So just want to share a little bit sort of different take on debt and good and bad debt. And hopefully this was helpful and opens up your eyes to maybe thinking about that differently and how it could really grow and accelerate your wealth building and help you get on that road to financial freedom. So take care, and we'll see you on the next episode of the Perennial Pride Podcast. Thanks for joining me on this episode today. I really am grateful for you as listeners to the Perennial Pride Podcast. I hope you're getting some tremendous value out of it and hopefully pushing you along your journey to financial freedom. I put this podcast together really to help you get more educated around your finances so that you feel empowered to live the life that you really want. And if you like the content that you heard today or watched, then I would encourage you to go to my website, perennialpride.com. There's tons of other content there. And you can access my book, Wealth Beyond the Numbers. You can buy it there on my website. It's a aggregation of a lot of great tips and tools I've learned to not only build my wealth in my accounts, but build wealth in my life and abundance and joy, and something that has a lot of my experiences in the journey that I've been on personally. Hopefully that can be also of value to you as you sort of move forward. So thanks again for being a Perennial Pride listener, and we'll see you on the next episode.